Today, we are going to talk about cash value life insurance and actual performance, what actually happens on policies, not just what is illustrated. What I'm really going to focus on is really dividend treatment and the long-term performance dividends have on whole life insurance policies. Have you ever heard that you should go with or you should consider a policy with a higher base premium, which results in you having less money up front because you may potentially have more money long term? There is some truth in that statement when you look at how illustrations and how life insurance functions, specifically dividend paying whole life insurance policies. But an illustration, projections, formulas that insurance carriers use on whole life insurance products in respect to their dividends is one thing, and then a completely different thing is what has actually happened, the real test of time. So we're going to get into that. We're going to look at some policies that have actually lived the test of time, that were well designed with minimum premiums, and then were designed not so well with higher base premiums, see what was illustrated, and then what actually happened. So this one will be fun. So the first thing I want to touch on here, because when it comes to dividend treatment on a whole life insurance policy, the topic of dividends can be a little confusing sometimes. For instance, when I hear of a company paying a 6% dividend rate, is that what I am actually earning on my cash value? No. We always want to remember that the dividend rate is a gross rate that is credited after the company's insurance expenses and mortality charges. Really what I want to focus on, if I'm interested in seeing the actual growth rate on my cash value, is my net internal rate of return. What's it growing by year over year, and as I average it out over a span of 10, 20, 30 years, whatever. But what I want to break down here is when we have a dividend rate on a life insurance company, assume it is 6%. What that consists of is two components. I have a guaranteed floor of 4% with whole life insurance products. This is pre-7702 change. When that change occurs, the guarantees will be different. But right now, I've got a guaranteed rate of 4%, and then the company declares a surplus in earnings. This is their surplus rate of 2%. The two together equate to that total dividend rate of 6%. Now, quick side note here is anytime we see a dividend column on a life insurance illustration, we want to remember that that is only the surplus rate. That dividend column on a life insurance illustration often does not include the guaranteed rate, the total growth. It's only the surplus piece. We've got other videos on that, which I'd refer you to, but it's always good to be aware of that because it can be a little confusing. I hear a company with a dividend rate of 6%, then look at my dividend column, it's nowhere near 6%. It's because the dividend column on an illustration only reflects the surplus rate. Here's what I want to touch on though. When I pay money into a life insurance policy, we frequently talk about policy design. If you design a policy properly, you will see maximum cash value from start to finish, and you'll be able to mimic what many big banks and corporations do. Here's the key. When I pay money into a policy, I can pay it where? Toward the premium or the PUA component. Let's assume I'm paying $10,000 per year into the premium and $10,000 per year into the PUA component. How do those dollars actually work when I pay them into a policy? What's the impact to me as the policyholder? That would be my question if I'm considering a policy. Well, in respect to base premium dollars, the insurance company will typically overcharge one for the base premium component in the first year and sometimes the first and second year of the policy. Meaning of that base premium policy, that base premium payment, nothing shows up in cash value right off the bat. Once I hit year 3 and so on, that premium does begin to come back to work for me. But the reason why nothing shows up in the beginning is the company is overcharging me for the death benefit up front. Whereas PUA dollars, if I made the same $10,000 payment, what I would find is $10,000 approximately would show up in cash value right off the bat. Why I say approximate, because I don't like giving answers like that, is companies do have PUA fees. I might see $9,800 show up in cash value immediately, and then it'll begin to compound. That's money I have access to. This is the key to accelerating the cash value growth on a life insurance policy. And it will buy me some additional death benefit. PUA stands for paid up additions, meaning when I make payments here, everyone does it for cash value, but it does purchase me paid up additional life insurance. Why it is paid up is that this component of a policy is flexible. I can choose to add money here or choose not to add money here. Very flexible in that respect. So a question we always get is, okay, how do I drive this as low as possible? The premium piece as low as possible and the PUA piece as high as possible. And the answer is often, especially with the top companies, we can drive the premium as low as 10%, and then 90% of my payment can go toward the PUA component. This would mean if I am paying in $100,000 per year, or I want the ability to pay in $100,000 per year, I can commit to a $10,000 minimum premium and then add up to an additional $90,000 into PUAs, dumping money into cash value per year. Very flexible where I'm not committed to that though. But here's what I want to touch on. An objection we sometimes hear, and this is very important to be aware of, is if one goes with a higher base premium, if it's 30%, maybe it's 60%, if I put more money toward the base premium, which will immediately result in less money in cash value up front and 10 out of 10 times less money based on my guaranteed cash values, if I put more money towards the base, I could have greater long-term performance on a cash value life insurance policy. Have you ever heard that? Take less up front because you could have more long-term. Here's where this argument comes from. So going back to how dividends are generated, I've got a 6% total dividend rate consisting of the guaranteed rate and the surplus rate. The guaranteed portion of 4%, that is credited to dollars paid toward base premium and PUA dollars in the exact same manner. So if I make payments toward base premium and that builds cash value over time, or PUA payments, the guaranteed rate is treated similar on both of those examples, both of those components, I should say. The PUA piece, however, that 2% rate, here's the difference. So it is true that the company pays the surplus on your entire cash value, but what you will find when you actually break down the dividend formula that most companies utilize, surplus dollars are much more favorable on base premium dollars long term. Let's demonstrate this because that can be extremely confusing. When I just see a surplus rate of 2%, common sense would tell me, hey, if I just have that 2% and I'm getting more money into cash value compounding, that should give me more long term. And the reality of it is that it will. However, if we hear, hey, if I go with a higher base premium, could that potentially generate more money long term? Let's take a look here. So here we've got the actual dividend formula for one company, and this is based off of an age 45 male paying in $100,000 per year for a period of 10 years and then dropping the premium down, but the total payment down. We're going to look at that example. Here's what I want to touch on. So the company's paying a dividend rate, and how they treat their base premium dollars and PUA dollars are different. Look at this long term though. What happens? For 9 years, the PUA component is more favorable, but then as time passes, what do we see? That base premium formula is much more attractive. It gets stronger and stronger over time. So we often see this, or this is the reason why we will see dividends on a life insurance illustration project higher or greater values long term when I have a higher base premium. So if this comes true, should I go with the higher base premium? Let me add something to this actually. What we often hear on top of it is, hey, dividends right now are at all-time lows. Can't get any lower. They're going to have to come back up. And when they do, that would make this even more favorable. So going with a higher base premium today will result in greater cash value long term. Here's the thing I want to touch on and really hammer home. This dividend formula here, particularly on the base premium, can be and almost always is adjusted by the insurance company, because dividends are not just made up of the insurance company's investment component. I've got mortality charges and insurance expenses, which can be and almost always are adjusted. So how do we actually know how much they can be adjusted by per year? Well, we've got several examples. We're going to look at two today. But check this out, just as a quick example here. Here's an in-force policy that we put in force about 5 years ago. Base premium formula was much closer to this when we first took the policy out, but here's what's happened. Look at that. They've continued to drop the dividend on the base, or I should say adjust the formula as far as how they pay dividends on base premium dollars. This could be confusing, so we're going to look at some actual numbers here in a second with actual policy performance. But this is the kind of stuff I want to look at. Very, very important. So let's take a look here at an illustration first to validate the new illustration point. We're going to look at a 45 male, which is what those numbers were based on. On the left, we've got a 1090 split. So this is a policy, $100,000 per year going in, minimum premium as low as we could drive it with this particular insurance company. $10,000 per year toward the base premium. We have a 1-year term rider attached, which we do cut off after year 15 in this example. And then the 30/70 split, which means 30% of my payment is directed toward the base premium. Everything else into PUAs. That's what I've got in the right. So let's take a look at a couple things here. As I look at these numbers, what do I notice? 100,000 goes in. Here's my base premium. 1-year term rider, PUA component, most important column if I'm purchasing a policy for cash value, 87.5. Zero dividend in the first year. Why there's no dividend in the first year is we attached a 1-year term rider, and that will result in the dividend being treated differently on a policy than without a 1-year term rider. This is why on the right, we see the same 100,000 going in, same company, same product, same individual, same health rating, $30,000 base premium, level term rider. Look at your dividend payout right off the bat, 53.11. What was it in the 1090? 0. So this could make it look like a higher base premium certainly favors the dividend payout, or I should say the dividends are favored toward base premiums because they are. Yet the cash value in the first year, 70,000 compared to 87.5. Here's your cash value difference. This is the important piece. Look at the net cash value, not just the dividends. So we fund it for 10 years, break even, 1090 year 5, 30/70 between 7 and 8. So there's an opportunity cost there we want to be aware of as well. Having access to the money up front and guaranteed values 10 out of 10 times. The lower the base premium, the greater the cash value long term. Why? Because the guaranteed component is treated in an identical manner to base premium and PUA dollars. This funded for 10 years and then we stopped. As we scroll down, what happens? 1090, significantly more cash all the way through, about $260,000. Now, let's take a look at a scenario where we can actually make the 30/70 look better long-term to conform with that dividend formula we looked at. This is going to be very interesting. So we've got the 1090 split. Same policies funded in the exact same fashion for the first 10 years. Everything's identical. Break even year 5 compared to 7 and 8. Okay. Drop the term rider on the 30/70 after year 10. The difference here is on the 30/70, which is again on the right. When we kick the funding down, we drop the PUA rider, base premium 30,000, and we're going to pay just the base premium. Pay close attention to that dividend column. Over here, drop the PUA, 100,000. I'm sorry, drop the total payment, reduce the PUA in this guy, 100,000 year 10, year 11, we wanted to keep the funding the same, so we have the same $10,000 base premium, the excess going into PUAs per year. This way we've got a true apples to apples comparison. So, time passes. Again, keep in mind that dividend here. Let's look at year 20. What do we notice? A $34,000 dividend with the 3070, a $47,000 dividend payout. And again, that dividend is what? Just the surplus component. We want to make sure we keep that in mind. Net cash value difference, 20 years in, $58,000 in favor of the 1090. If I go down 30 years, $64,000 dividend, 1090, $81,000 dividend, 3070, yet the 1090 design still has about $40,000 more in net cash value. So for the first 30 years, I had more all the way through, greater opportunity cost. Now, look at this. Remember that formula? Long term, it's more favorable on dividends, on base premium dollars compared to dividends. Here we go. The 3070 overtakes this when the individual's in his 80s. Now, most would look at this and say, who cares? Like, I've got more money all the way through. I can do a lot more than the extra couple percentage points the company will give me. But why it looks that much better is, again, due to that dividend treatment. So, if dividends come up, if the dividend rate increases over the span of 30 or 40 years, could this look even better, or could this one pull even further ahead? If I look at age 95, there's about a $100,000 difference, or a $70,000 difference. So if dividends go up, that gap could widen even more. That's often what we hear, and often a reason why we're told it might make sense to go with the higher base premium. I want to integrate something here, or mention something here. If it did make sense, if we knew this actually happened based off of that base premium and dividends, like if we knew that actually happened, we would recommend this because it would generate 3 times as much revenue for my company. However, we always got to dig deeper, because what happens with whole life insurance all the time? People purchase policies, they often under-deliver, and that makes it very easy for financial advisors that are against whole life insurance, Dave Ramsey, and individuals like himself, to attack whole life because it often underperforms. Going back to that formula, when does it underperform? When we looked at the new illustration, by year 10, I'm looking more favorable based off of the base premium. However, in reality, what a stark difference there. So what we're going to do next is look at an actual policy here, 2 of them that have lived the test of time. One was put in force when I was in college, but we were able to obtain servicing rights and look at the actual performance. But here's what we hear. Here's what I want to touch on. Based on the illustration, a higher base premium may project stronger long-term values. That's the key. It may project stronger long-term values. But the question is, in reality, will that actually happen? Let's take a look. So we've got a policy here that was issued in 2007. This case study took me a long time to put together, but I had a ton of fun doing it. So obtaining the original illustration was a little bit of a challenge in itself. This is based off an age 30 male, purchased a whole life insurance policy with one of the major mutual companies that always deliver if the policies are designed properly. This is a 100% base premium policy. The purpose of looking at this is to see exactly how dividends are treated on base premium dollars, and then measure what was projected and then what actually happened. Because it lets you know the company that this policy is with, I use heavily myself and see drastically different results because the design is much different. So here we go. Issued in 2007. Let's take a look here. So what we've got going on, we've got policy year, his age, 30 when he started, began in 2007. The company's dividend rate at the time of purchase was 6.75%. So the illustration, that original sales illustration, was based on that 6.75% all the way through. Annual outlay, $24,000 per year. Total outlay, this is going to track his total payments over time. What's highlighted in yellow represents the illustrated break-even point between years 10 and 11. Annual dividend. This is an old school whole life insurance policy where dividends are not paid during the first and second year. However, on base premium dollars, I should say. However, when we start to break this down, it's going to get really, really interesting really fast. Illustrated cash value and illustrated death benefit. We'll progress on to the actual performance. Here's what I want to touch on. Year 3. The dividend, what's happened with it when we look at reality? 675, 72, 73 came up. Year 3, dividend on this illustration was 6.75%. The projected dividend payout was $390, and the illustrated cash value was $44,553. Compared to what actually happened, how we obtained this data, by the way, was not just through in-force illustrations. We looked at several of them that were generated over the years. How we obtained this is we actually pulled the annual statements and summaries from each year of the policy as far as what his net cash value was at the end of each year and what the annual dividend was that was actually paid to his policy. We wanted to make sure this thing was accurate. So year 3, again, the dividends come up 7.25 and then 7.3, yet the dividend he actually received was the same as that illustration, $390, based on that 6.75% rate. Look at your cash value though. $44,139 is what he actually had, and what was projected originally, $44,553. Why is it less when the dividend payout was the same and he did everything according to plan? Exactly. What's the difference there? Here's the difference. Dividends are made up of what? A company's investment component, mortality charges, and insurance expenses, which can be and often are adjusted by the insurance company. Like that in-force data we had on dividends where we saw it just got cut down on the base premium. That's the kind of stuff that happens, which is resulting in that cash value being less. Now, as we look at this over time, what happened here? Next year, dividend, based on that illustration, $401. Dividend interest rate, 7%. Okay, I'm still higher than what was originally illustrated, yet the actual dividend payout is less, $1. Now, granted, it's $1 less. It should be much more because the dividend has been coming up and he's been doing everything exactly according to plan. So like, what's going on here? Cash value, actual performance is less than illustrated. Now, as we look at this, here's what I want to hit home here too. Dividend rate in 2013 was 6.65%. Dividend payout was $427. What was originally illustrated, based on that 6.75% dividend every year, $1,084. And there's a gap now, and it's becoming significant year over year. He reached out to us, I believe it was 2015 or 2016, with concerns. This is when we started to review the policy and analyze it because it was not performing as what he was told it would do. This is what happens so much in the industry and where people have buyer's remorse because things do not pan out. So here's again what I want to touch on. Huge distinction in the dividends. Now, look at this. The dividend rate has come down each of these years, but he's pumping money in, $24,000 per year, and his cash value is increasing. But why does the dividend, the net payout, come down for 2 years? Because that reduction in the dividend rate should not result in the actual dividend payout decreasing. Again, on the base premium component of a life insurance policy, that can and almost always is adjusted. So what we see on illustrations is completely different from reality. So important to be aware of this. And really, if we just copy what the ultra wealthy do in big banks, we'll be set up okay. But here's where it gets so interesting. Dividend comes down. Finally, at year 10, starts to increase. $940. Now he should have been, based on that original illustration, almost $3,700. What's the cash value delta here as well? That was his break-even point, just about on the projection, 238. What he actually has is 225. Now, through 2020 is where we had all the summaries. He's entering his 2021 policy anniversary date. What was projected on that illustration, and then what actually was received. Cash value, $355. Projected, $392. And in-force illustrations, as we've looked at them, each year the policy keeps on underperforming. So this is an example often of what we state what not to do with a high base premium all insurance expense. But the purpose of what it illustrates is whatever that base premium component is, regardless of how much you have going into PUAs, that can be adjusted. So when we discuss that whole 1090 or driving the premium as low as possible, we are taking elements outside of the insurance company's control because they can adjust that, or I should say we're minimizing their control and allowing more money to go into PUAs, which we see greater value off of from start to finish. This is where we're so big on maximizing cash value, even though it minimizes our compensation to the absolute minimum degree. I've got no problem with agents making money. I don't. But if it comes at the consumer's harm, then I do have a problem with it. Now, here's what I also want to touch on. So that dividend, 2038, here's what was projected on the in-force illustration. 2467, but he actually got 2038. Next year, it's projecting 3855. It's never jumped that much. It actually came down the past 2 years. So what's actually going to happen? This is where we'll continue to track it year over year. Very interesting though. So in respect to how dividends are paid on base premium dollars, when we see that age 45 male, hey, as time passes, you could definitely have more money long term. But will it actually happen? I highly doubt it. We've never seen it actually happen. It's not how corporations, banks, and wealthy individuals set up policies by any means. They take the cash value up front, and those historical policies we see actually deliver have the cash value up front. When I say actually deliver, short-term and long-term. Let's take a look at that. So here's the example we just looked at. Here's a policy we put in force in 2016. On the left, we have the original illustration. At the time, based on a 7.1% dividend rate. Now, if you look at these numbers and say, wow, I'd like this product even based on the current dividend rate, they did discontinue it. They do have products very similar to it, but companies are always updating their products and discontinuing certain ones. However, it does give a good depiction of whole life. So his plan was to pay in $150 for 3 years, then $125 per year through year 6, and then $50 through year 10, getting a total of about $1 million in. Was receiving funds. They were going to go nowhere but cash. He had money in cash, said, hey, here's a great, safe, liquid, tax-free area I can position money. I can also use it to take advantage of real estate opportunities, which is exactly what he's done. Had a low loan interest rate. Now he's collateralizing it through other third-party lenders for the more attractive interest rate. But let's get back on track here before I just ramble. So based on that 7.1% dividend rate, the annual dividend, which again, remember, is just the surplus rate, not the guarantee. That's not included in there. I also want to just emphasize, I know we touched on this in the beginning, but this is a longer video. That 7.1% dividend is not what I am actually earning on the policy. Here we've got the annual internal rate of return, which is what the policy is actually growing by. When I look at it, year 1, he paid in $150,000 and he has $133. Annual IRR, no matter how you slice that, is negative 11%. It is. I put that much in, that's my hit. Granted, I have a sizable death benefit, which is nice if anything happened, but focusing on the cash value, which was his goal, this is what it projected. Now he backdated the policy, and we actually saw the cash value land at 128,356. But then what's interesting, look at year 2, it projected 274,668, and it produced 273,111. Dividend payout, 39.83, same thing. Base premium, it's a little bit under 15,000 in this example. With the term rider, the base and term rider combined, we're at about 15K, slightly higher than it. Everything else, dumping it into PUAs. Next year, pays in 150. Dividend was 7.1, came down to 6.7, came down to 6.4. So the dividend has been declining. Over here, holding steady per the illustration at 7.1, you're at about 7,500. So you see a difference there. Here's the beauty of it though. And this is where properly designed policies come into play and in terms of actual performance. The last policy we looked at kept on under-delivering more and more because that base premium was so high. Here we minimized it, the opposite end of the spectrum, as low as we could go. What do we notice? What's in yellow? Your break-even point. Money's positive between years 3 and 4. There we go, just like projected, between 3 and 4. Now, when we hit year 4, the original illustration becomes a bit invalid. The reason why is he's paid in 150 year 4, where he originally anticipated on paying in 125. So the numbers start to get skewed. I don't want to say, hey, look, we got 607 when it projected 590. It's like, no, he paid in more money. Let's get rid of this. So let's focus on the in-force illustration now. Year over year, so he paid in 150, 600,000 for 4 years. His actual performance was 607. Here's his dividend payout year over year. Dividend rate has continued to come down. 2021, he's about to complete policy year 6. Dividend rate was what? Or is what? 6% flat. Here's his net cash value growth, backing out the premium he pays in as well. So whenever I look at the growth on a policy, I don't want to say, hey, you gave $35,000 and look, it grew from $759 to $833, close to $100,000. No, I'm going to back out the $35K he's paid as well. That's my net cash value growth. That's important to look at. Back out my own payments. So there's the growth over time. Here's my dividend rate. Here's my annual internal rate of return. Very interesting. If you've seen older videos of ours where we always talk about the dividend rate on a life insurance policy is a gross rate, but we can expect that net IRR likely to fall anywhere between 1 to 2% below the dividend. If we crunch the average IRR in this, because this is the annualized, just year over year what I'm earning, it'll fall around 4.5%, a little bit stronger, but that's where it's going to fall. Strong policy will continue to track the performance over time, but he's satisfied with it. It is actually delivering. Same 1.025 million in, 1,679 over here, 1,988. But again, numbers are skewed because you got the money in faster and we're basing it off of a much, much higher dividend rate in the past. So it's interesting when we look at how dividends actually impact performance. And I never thought I'd have to really go in detail on this, but projections display that a higher base premium can give a consumer greater long-term cash value. The reality of it is we have not seen that happen. Cannot get it from companies, producers. Every time we get an in-force illustration, it shows the opposite as opposed to a maximum design policy, which is, by the way, what banks and wealthy individuals do. You see the opposite there, where it's reality, minimum premium policies produce stronger cash values. Dividends on base premium dollars, extremely sensitive. A higher base, like that policy issued in 2007, often under-delivers, and again, that's where whole life has become really a target to so many individuals that are anti-whole life. So here's a summary, let's call it that. Here's a question I would pose. If considering a policy and you're looking at maximum cash value, or you're more comfortable with a higher base premium, which is perfectly fine. My big thing from a business philosophy standpoint is show all the options, and then the consumer can select the option that is really in their best interest. But do we want to give up higher guaranteed values? So what's guaranteed for the potential of greater non-guaranteed value long term? So do you want to give up what is guaranteed for the potential of greater non-guaranteed value long term? And on that question, history has shown that that potential greater long-term benefit has always existed, but it's never paid off. Never. We haven't seen it yet. If we do, that would be great, because that may make sense to then sell higher base premium policies. But again, if that's not the case, we're not going to do it for a higher compensation. Here's what I often feel like. I feel like it's a game when we hear about this all the time, as far as go with the higher base premium because dividends will come up, which means you'll have more money long term if you go with the higher base premium. That doesn't happen. I feel like it's a game just to justify why we should sell a policy with a higher commission from start to finish. Like, that's not, no, you're not going to do that stuff. We need to see the actual performance, because if a policy is truly maximized for cash value, we are put in a position where we have more money from start to finish every time based on the guarantees. And then if my goal is just to park money in a cash value life insurance policy and just use it really as a bond alternative, a lot of people have expressed that to us. Or if my goal is to use the policy for retirement income, perhaps it is to borrow and repay, take advantage of opportunities. All I'm doing is capitalizing the policy as fast as I possibly can and building in flexibility. This way I'm committed to a minimum premium and can add more discretion. I don't get billed with this huge amount every year, and I've got more money to work with. Know that this was a lot of information. I hope you enjoyed it. I had a lot of fun putting this one together. If you have any questions, please feel free to reach out anytime. If you'd like to see any policy samples, reach out. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.